live at CME HQ with breaking news. Our third quarter final read on non-farm productivity and unit labor costs, minus 5.2 on productivity. Not a good number. This adds to the previous number at 5.0, so the final read now becomes 5.2, the worst in about a dozen years. And if you look at unit labor costs, here's the reason why productivity plummeted, because it jumped up to 9.6 from 8.3, 9.6. Now, this is the highest unit labor costs going all the way back to, well, it was 13.3 at the end of last year, so fourth quarter of 2020, to give you an idea. And that number was a 20-year worst. And as far as trade balance for the month of October, minus 67.1, minus 67.1. So that is good news. And in the rearview mirror, our last look was revised from minus 80.9 to minus 81.4. And that is the worst level since record keeping going back to 1992. We see interest rates are up a basis point at 1.45% in 10 years, unchanged at 177 in 30-year bonds. But that is a big jump from yesterday. The curve actually starting to steepen a bit. And we are now looking at the longer end interest rates. The short end was the star of the program for about the last month and a half, pulling forward rate hikes. And it certainly seems as though the taper is going to be quicker. Maybe we'll be done in March and start raising rates. But no matter how you slice it, the long-dated maturities have woken up a bit. Maybe it'll be CPI at the end of the week that'll really give long-dated treasuries an eyeful of propelling it higher due to higher inflationary pressures. Andrew, back to you.
Thank you, Rick. I want to jump right over, though, to Steve Leisman, who's looking at these numbers as well, get his reaction to it all. Steve?
Yeah, Andrew, if you don't mind, I want to pick up where Rick left off here, which is very interesting that the market this morning, at least the short end of the market, seems to really be incorporating the news that we reported yesterday and has increasingly been out there of an accelerated taper and a faster Fed. Take a look at Fed funds probabilities, which now are near 60% for May, and then they ratchet on up as the summer and the fall come around. And then there's that second hike, which is now in November. And I need to do some more research on this, but it looks like a third hike is starting to creep in to the equation there for December. It's around 50%, but I'm not happy with the numbers right now. But certainly these are good numbers here. We're increasingly the market. And then take a look at the 2-year note, which is really on the move this morning, up near 67 basis points. The idea that, again, the 2-year note has to price in the near-term outlook for the Federal Reserve much more aggressively than the 10-year ever does, which is marches to its own tune. And what you see there is all of this is about a flattening, a compression, where the 2-year is moving now back to where it was before March, before the pandemic, really, in March of 2020. So this increasingly going on. And I think the big story here, Andrew, is that the stock market doesn't seem to care. Yeah, the Fed's going to go faster. Yeah, the Fed's going to have a faster taper, maybe quicker rate hikes, maybe more next year. It is pretty remarkable the way that the stock market, so focused on Omicron and those outlooks for the economy, has really incorporated this news, and really a yawn. I don't know, Andrew. Maybe someday it wakes up and says, oh, my God, the Fed's going to taper faster, the Fed's going to hike faster. But the focus right now is clearly on the virus and seems to be taking pretty well this idea of a faster Fed.
But, Steve, and we were talking about this earlier, if Omicron is, in fact, milder, and we don't know that yet, to some degree you could say that might make the possibility of supply chain problems in the future less severe, which would mean less inflation, which would almost reverse a little bit of the idea of what Jay Powell may have to be thinking about.
I was with you up until the very last part of your sentence there, Andrew. Okay. I think all of that is true. In other words, a less virulent variant of the virus is good news for the economy, good news for inflation. I still think the Fed's going to be a little bit like the post office here on this faster taper. I think the message that Powell gets from the market here is that it doesn't seem to matter that much if the Fed does a little bit more tightening, and I think they're going to be more comfortable with a little bit more tightening. I think that neither rain nor sleet nor whatever all those terrible elements are that the guys, our delivery guys come through. I think the Fed's still going to do its appointed rounds of a faster taper. The bigger story with what you're talking about, I think, comes next summer into next year with how far the Fed goes, how steep is that curve, as well as how far it has to go. I think that we'll get a really good feel December 15th. We'll look at the Fed's long-run rate and where they see the long-run funds rate, and that will tell us more about what this critical question of the terminal rate is. But right now, you look at the 10-year or the 5-year, you do not see a market that expects a very aggressive Fed over the long haul here.
Shepard Smith here. Thanks for watching CNBC on YouTube.